How can a humble janitor from rural Vermont, whose jobs included fixing cars at a gas station for 25 years and sweeping floors at JCPenney for 17 years, leave behind a fortune of $8 million upon his death? In a similar way, how can a Harvard-educated Merrill Lynch executive with an MBA retire in his 40s with multiple homes, but eventually lose it all and declare bankruptcy? In the book, Psychology of Money, author Morgan Housel explores people and their relationship with money. In this video, I'll talk about the 20 lessons from this book in under 20 minutes. So let's get started. Lesson number 1, no one's crazy. We're all different people and we're all unique, and our personal experiences with money probably make up about 0.00000, you get it, 0.001% of what's actually happened in the world, but maybe about 80% of how we think that the world works. A person growing up in poverty versus the child of a wealthy banker will have different risk and reward systems. In a similar way, a person who grew up with high inflation will think about money differently than a person who grew up when prices were stable. People's investment decisions are generally based on the experiences they have early in their life. Lesson number 2, luck and risk. Bill Gates, love him or hate him, it's hard to deny he's one of the most successful people on the planet today. But in 1968, he was one of the few children who had access to a computer, literally 1 in a million. Gates attended a school called Lakeside, which had a computer. Gates himself has said, if there had been no Lakeside, there would have been no Microsoft. Now, Bill Gates had a friend called Kent Evans, who was also a computer prodigy and would have gone on with Bill to possibly found Microsoft, but he died in a mountaineering accident before graduating high school. Luck and risk. One experienced luck, the other experienced risk, both a 1 in a million probabilities. And we as humans tend to overlook the role change plays in our financial lives. We celebrate those who are successful, but we often ignore the risks or failures that got them there. The author's recommendation is we should pay attention to broad patterns in finance instead of focusing on specific individuals and their success stories. Lesson number 3, never enough. Why do rich people do crazy things? It's because they never have enough. The hardest financial skill is getting the goalpost to stop moving. The taste of having more money, more prestige, more power increases ambition faster than satisfaction. Related to that is a problem of social comparison. Imagine a rookie baseball player who earns about $500,000 a year. He's broke compared to a superstar player who earns $50 million a year. Now, that superstar player compared to the world's highest hedge fund manager earning $340 million a year is broke. The hedge fund manager comparing himself to Warren Buffett, yeah, you get where this is going. There's always a bigger fish to compare ourselves to. Having enough is realizing that this insatiable appetite for more is going to lead people to regret. There are certain things in life that are never worth risking. Reputation, freedom are invaluable. Family, friends, and happiness and being loved by those who you want to love are all things that are more important than chasing money. Lesson number 4, confounding compounding. Here's a mind-blowing fact for you. $81.5 billion of Warren Buffett's $84.5 billion net worth came after his 65th birthday. If you think that's crazy, and the author agrees, our minds are not built to handle such absurdities. Warren Buffett's success isn't just because he's a great investor. It's because he's been investing consistently since he was a literal child. His skill is investing, but his secret is time. That's how compounding works. If he started at 30 years of age and achieved the same success, we wouldn't even hear about him. Warren Buffett has over 2,000 books written about him, all analyzing different aspects of his life and his career. But they might as well all be put under one book called This guy has been investing consistently for 75 years. That's the magic of compounding. Lesson number 5, getting wealthy versus staying wealthy. There are many strategies out there on how to get wealthy, but how do we stay wealthy? It requires some combination of frugality and paranoia. Frugality plus paranoia equals developing a survival mentality. Being consistent with your money is hard. 40% of companies that have ever gone public have eventually lost all their value over time. We should plan for our plan to fail and not go according to how we want. This means being consistent and not panic selling when the markets drop and when that next disaster hits. Gains from long-term compounding will eventually make you the most money. Lesson number 6, tails you win. A tail event is an outlier event. It's a 1 in 1,000 or millions event. Examples of tail events are everywhere around us. In 2018, Amazon was responsible for driving 6% of the S&P 500's returns, their growth being exclusively due to Prime and Amazon Web Services. Tail events in a company that has experimented with hundreds of products, from the Fire phone to travel agencies. Apple was responsible for 7% of the index's return in 2018, most of it on the back of the iPhone, which itself was a tail event tech product when it launched. Accepting that tails drives everything in business, investing, and finance means you'll realize that it's normal of things to go wrong, to break, to fail, and to fall. Take Warren Buffett, again, for example. At 2013, at his Berkshire Hathaway shareholder meeting, Buffett mentioned that he's owned 400 to 500 stocks during his life and made most of his money on 10 of them. Charlie Munger followed up with, if you remove just a few of Berkshire's top investments, its long-term track record is pretty average. The important lesson here is that we overlook the fact that our role model successes and gains came from a small percent of their actions. Lesson number 7, freedom. Waking up every morning and saying, I can do whatever I want today. That is the highest form of wealth. Having the ability to do what we want, when we want, with who we want is truly priceless. This is what money can help us achieve. Money can help us control our time, and that is the highest dividend that money pays. Lesson number 8, the man in the car paradox. When you see someone drive a fancy sports car, you rarely think, wow, that guy driving the car is cool. Instead, we think, wow, if I had that car, people would think I'm cool. That's generally how most people think. The paradox here is, people tend to want wealth to signal to others that they should be liked and admired. But in reality, most of us are too busy with ourselves. Not because we don't think wealth is admirable, but because they use your wealth as a benchmark for their own desire to be liked and admired. Most people want to be liked and admired, and being kind and humble may be a better way of achieving that rather than the fancy things that you buy. Lesson number 9, wealth is what you don't see. Imagine someone driving by in a Ferrari, an expensive sports car again. You might think that that person driving a $100,000 car is wealthy, but that's the only data point we have about their wealth. And we humans tend to judge others based on what we see. We can't see people's bank accounts or their mortgage statements, so we rely on outward appearances such as cars, houses, vacation photos on Instagrams to judge people's wealth and get an idea of their financial success. But true wealth is financial assets that haven't been converted into the stuff you see. The watches that haven't been worn, the diamonds that haven't been bought, the fancy clothes that haven't been worn, first-class upgrades that have been declined. Being rich and wealthy are two different things. Someone earning $100,000 and driving a nice car is rich. Rich is their current income. Wealth is hidden. Wealth is income that's not spent. Wealth is an option not yet taken to buy something later. The value of wealth lies in offering us options and flexibility to one day purchase more stuff that we could purchase right now. Lesson number 10, Save money. It doesn't get much more simple than that. If we want to build wealth, personal savings and frugality are parts of the equation we can control. You can build wealth without a high income, but it is harder to build wealth without a high savings rate. Saving money offers us flexibility and control over our time, and time is one of the most valuable currencies in the world. Lesson number 11. Reasonable over rational. The famous founder of low-cost investing, Jack Bogle, invested in his son's high-fees active hedge funds, and when asked for an explanation, he said, "We do some things for family reasons. If it's not consistent, well, life isn't always consistent." Human beings are full of emotions and feelings. We don't operate like spreadsheets. When making financial decisions, the author argues we should aim to be pretty reasonable versus coldly rational. Reasonable is more realistic, and we have a better chance of sticking with it in the long run. Lesson number 12. Surprise! We've all heard that quote that history repeats itself, right? But in the case of investing, the author argues we should not look at historians as prophets. In investing, history often doesn't account for outlier events or structural changes. Events such as the Great Depression, World War II, and infamous personalities such as Hitler, Stalin, or Mao. They all had profound effects on how the world we know today exists and works. History can also be a misleading guide to today's world due to the constant change in the world of finance. Example, the 401k is only 42 years old. Venture capital barely existed 25 years ago. The S&P 500 looks different than it did 50 years ago, where tech stocks were non-existent, but now they make up 1/5 of this index. The author argues that the further back in history we look, the more general our takeaways should be, because the further back we look, the more likely we're looking at a world that no longer applies today. Lesson number 13. Room for error. We should plan for our plan to not go according to plan. Having room for error allows us to be ready for a range of potential outcomes, even things we never imagined, such as a global pandemic or a natural disaster. When estimating your future returns, we should assume they will be a certain amount lower than the historic average. The author uses 1/3 lower than the historic average. In this way, we end up saving more than expected and end up building our margin of safety. Lesson number 14. Long-term planning is hard. People change, their goals and desires change. We humans are poor forecasters of our future self. We often change our minds at different periods in time. To counter this, we should avoid the extreme ends of financial planning. Don't assume you'll be happy with a very low income, and don't work endless hours in pursuit of lots of money. You'll regret both. The author suggests we should accept a life of being moderate in our saving rate, or moderate in our free time, and having at least moderate time to spend with your family. All this increases the odds of us being able to stick with the plan and avoiding regret than if any of those things fall to extreme sides of the financial planning spectrum. Lesson number 15. Nothing is free. Everything has a price, even successful investing. The price of successful investing is volatility. Volatility is fear, doubt, uncertainty, and regret that successful investing demands. It's a fee, the author argues, not a fine, of being a successful investor. And like most products, the bigger the returns, the higher the price. For example, Netflix stock returned more than 35,000% from 2002 to 2018, but traded below its previous all-time high on 94% of those days. Another example, Monster Beverages returned 319,000% from 1995 to 2018, among the highest returns in history. But it traded below its previous high 95% of the time during that period. Most people try to avoid volatility in investing, but this is the price of good investment returns. Lesson number 16. You and me. Imagine turning on CNBC and you see a popular talk show host telling you, "You should buy this stock." Who are they talking to? You could be a teenager trading for fun. You could be an investor planning to retire shortly. Or you could be a young parent that's starting an investment account for their child. Everyone has a different goal and their own investing time horizon. The author recommends it's important we understand what investing game we're playing so we act accordingly on our investment decisions. Lesson number 17, the seduction of pessimism. Pessimism in finance often sounds more smarter than optimism. Optimism, on the other hand, can often sound like a sales pitch. When something bad happens, it tends to catch our attention. Optimistic forecasts in finance are often ignored over forecasts suggesting doom and gloom. It is important to keep this in mind when making financial decisions. Lesson number 18, when you'll believe anything. Humans love stories. They're more powerful than statistics. They're also a pretty powerful force in the economy. They can let tangible parts of the economy work, or they can be the brake that holds our capabilities back. The more we want something to be true, the more likely we are to believe a story that overestimates the odds of it being true. Investing is one of the only fields where there's so many opportunities for extreme rewards, and this leads people to believe in some pretty extreme stuff that they wouldn't normally believe in other fields. For example, 85% of active mutual funds underperformed their benchmark over the 10 years ending in 2018. That figure has also been very stable over time, but there's still almost $5 trillion invested in these funds. Everyone has an incomplete view of the world, but we form a complete narrative to fill these gaps through stories. Lesson number 19, all together now. In this lesson, the author summarizes his core beliefs of the book, and some of the important points include: less ego equals more wealth. Become okay with things going wrong. Use money to gain control over your time, because not having control over your time is a powerful and universal drag on happiness. Be nicer, be less flashy. Nobody is as impressed with your possessions as you are. Save money. Just save. You don't need a specific reason. Avoid extreme ends of financial decisions. Have room for error in your financial decisions. And lesson number 20. In lesson number 20, the author highlights how everyone's finance journey is different. We have to find out what works for us. For most investors, Housel recommends dollar cost averaging into a low-cost index fund will provide the highest odds of long-term success. That's it, folks. 20 lessons from the psychology of money in under 20 minutes. I hope you liked this video. If you've made it this far, thank you for watching. Please remember to like and subscribe to help the channel out. Really appreciate the support. Till next time.